Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. We're engaged in a long series in what to do in the financial planning category when we get to the area of long-term care planning. If you or a loved one might need to go into a nursing home at some point in the future, or need care or required advanced care but are able to stay at home, is there a way to provide that type of care without going broke? So that's what we're talking about. The toughest area I know of in all of retirement planning, in all of financial planning. So I've gone through and turned the page, as I say it, on a number of different options that all families and business owners and just people of every walk in life have to deal with and choose from. So we went through the do-nothing plan. We went through the carve out some portion of assets to take care of it. We went through self-insuring it. We went through having a loved one, maybe a child or a daughter or a son, quit their job but be able to come and take care of you. Or maybe they're not working right now and can take care of you, or you move in together. We're now in the area of if you are looking to possibly buy insurance to transfer the risk to an insurance company for you in exchange for a smaller premium now, while you may or may not need a future benefit. And in return, if anything does happen to you, then the insurance company covers a larger majority of the cost. That does not mean the insurance company would pay the whole cost should you need to go into a nursing home, but it means that you're making choices now on what level of risk you want to transfer to the insurance company. So you may not buy the coverage tailored to cover anything that could happen in the future, but you may buy a coverage to purchase a base benefit to help you afford the costs of care that you might otherwise be unable to get. Now remember, when we talk in this segment about shopping for long-term care insurance, there are those of you who are unable to qualify medically for insurance. And that's when we'll get into in some of these later sessions that I'm going through in this series of, do you want to get involved with the attorneys and Medicaid planning or make other arrangements with your family, things like that. Go into a retirement home now. Some people might choose to sell their house now, turn the assets over to a retirement community and pay that way, and then pay ongoing rent instead of expenses for maintaining the house. But that's also very expensive. So as I said in my first show on this series, there's no easy solution, but the one that's usually the most expensive is the all or nothing decision of do nothing and hope it doesn't happen to you. Because if your number's up and either you or a loved one has to go into a nursing home and you've done no planning, which in effect means the do nothing plan, or what you or others might refer to as the self-insurance plan, you can go broke. So, and we haven't even talked about some of the other areas. There are some areas of protection for spouses at home, and we'll get into that in later shows in this series. So I won't leave anything out along those lines. But in this session, and in the next upcoming sessions, and in the past couple, we're talking about buying long-term care insurance, what to look for, how to shop, how to know what coverage options are available, how much does it cost, who buys it, who can afford it, etc. At what age should people buy it? That's what we're into today. So what I came across was, and I want to share with you over the next couple shows, there was a survey that's done in the insurance community, and it's by Broker World magazine, the one that I pulled. It's actually a 2014 survey based on 2013 results. So I want to share a lot of this with you, and it'll take too much time for today's show, so it will extend over for the next couple shows, because this is the crux of the whole industry of information to help guide you making decisions, which, as you know, is why I put out this show to begin with. So the first thing, and I'm reading from this, the 2014 Long-Term Care Insurance Survey is the 16th consecutive annual review of long-term care insurance published by Broker World magazine. And what they're saying is, in this survey, unless it's otherwise indicated, and I won't read to you the whole survey, I'll highlight points that are of interest to you, but unless it's otherwise indicated, they're talking about standalone long-term care insurance. Now, what that means, I will be getting into in future shows, what we might refer to generically as hybrid coverage or hybrid policies. What that might refer to is a life insurance policy, but it has a long-term care rider on it, or a fixed annuity, but it has a long-term care rider on it. So they're hybrid policies. I'll refer to them generically as hybrid policies. But a true long-term care insurance policy, or as referred to in this article, a standalone long-term care insurance policy, is what this survey encompassed. So not to get those confused. And again, I will go over those in some future shows here in this series. Standalone doesn't include any of the death benefit riders or annuities or disability benefits. Now, in their 2008 article, Broker World article of 2008, there were about 45 insurers selling standalone individual or group long-term care insurance. Now, there are only 16. And this is as of 2013. So we don't know what effect 2014 had, because I haven't seen the report yet. It hasn't been generated out to us producers. Sales on this, industry sales, they go on to say, were down 26%, 26.5% from 2012 in terms of premium. So sales plummeted almost a quarter, and down almost 23% in terms of the number of people that bought individual policies. So sales are way off. Less people are buying, less people are focusing on transferring the risk to long-term care insurance. So now the average premium on each policy is also a little bit lower. Now you're going to want to ask me, what's the average annual premium, aren't you? Well, this report helps me answer that question, because they're stating in this report the average annual premium reported by all these companies that did report, and not all companies reported, was $2,400 a year roughly. It went down to $2,300 a year in 2014. So the premiums actually reduced. We know the premiums didn't reduce. I mean, I know that from the industry. So what caused the average premium to be smaller? Well, pretty much two things. Number one, people are somewhat choosing less in limits, in the benefit limit. And number two, shorter benefit periods. So people are designing policies to engineer the costs down, but they're getting less for it. So you have to be careful, and I'll go through this. That's why I'm going to share this survey. We're going to talk about what to look for in long-term care insurance, restoration of benefits, shared benefit, premium waiver, whether you want non-forfeiture options, which are premiums back if you don't go into a nursing home, inflationary increase options, CPI options, home health care riders. I'm going to go into that, many of the features that you're going to want to look for. But That's what people are starting to do. They're squeezing down a little bit some of the options they're choosing, and they're not buying as much coverage as a rule here. Maybe that'll come back, maybe it won't. Now, worksite sales, which are group insurance, that's when the employers are offering the benefits on a group basis, are down almost 30% less than they were in 2013. So sales are way off because offerings of products are way off. Now, the sales picture, interestingly enough, it reports, is worse than the numbers indicate. And it goes on to say this: it is striking that sales are down so much despite fire sales, such as single women buying before the introduction of gender-based pricing. You say, what? I don't understand anything you just said. Sales are down in spite of gender-based pricing coming right on the forefront, and here's what it means. Prior to 2014, we saw most companies pricing men and women the same. Now, statistically, women live longer than men. Statistically, life insurance has always been less expensive for women because they'll live later. They'll live longer, which lessens the risk for when an insurance company might have to pay out a death benefit. They'll be older, which means the insurance company will have collected potentially more premium on that person, et cetera, et cetera. Because of that same factor, women tend to have an experience of living longer than men. That makes the long-term care insurance risk worse for women. More women are in a nursing home, more long time periods than men if they're even in a nursing home. So that increases the amount of monthly bills the nursing home policy is going to ultimately possibly have to pay. So the women's premiums should be more for long-term care insurance, pro rata for the risk, the insurance industry says, and the women's life insurance rates should be less because of that same longevity factor. Well, what happened was the insurance industry began announcing that starting 2014, they were going to begin gender-based pricing, which means single women rates were likely to possibly go up. So buy your policies early before the companies start with gender-based pricing. That didn't happen. Why? I don't think anybody knew about it. So they didn't take advantage, especially the single women. So that was interesting in the article where they were saying some companies in 2014 and 2015 are still offering neutral-based pricing, men and women the same, and other companies now have already embraced gender-based pricing. So there's some of both. So my first area of advice is when you're shopping for coverage, if you're a male or a female, ask that question. When you're shopping different companies, are you gender-based or are you neutral-based? And it might factor into why one company is less expensive than another for apparently the same coverages. And it might offer you the opportunity to buy more coverages than you otherwise could buy because you had not looked at enough companies. Okay. Now the next thing, claims. You know and have read and heard long-term care insurance companies are dropping out of this industry and out of this area of providing insurance like flies. Why? Well, it's claims, folks. They're not selling enough policies, they're not generating enough premium, and they're paying out more in claims than they are every year prior. And this is no exception. 2014, participating insurers, and they mean participating in this survey because not all insurers did participate. Participating insurers, it says, paid $3.4 billion in claims in 2013 and have paid nearly $25 billion since inception. But overall, it says the long-term care industry incurred $7 $8.7 billion in claims in 2012. And it said a lot of these claims were paid by insurers that are no longer in the long-term care insurance business. Now, again, you have to ask me, what does that mean? You just said they're paying and they're no longer in the business. Well, folks, we've seen the newspaper articles over the last 5 and 8 years of insurance companies, stress on insurance companies providing long-term care insurance, coming out to you with letters. They have to raise your premiums. And some of them a lot, like 40%. Or you have to reduce benefits if you want to keep the policy premiums somewhat close to what they were. Well, some companies dropped out of the long-term care insurance business. Now, I want to ease some concerns you have hearing that and that I had when I first heard it. I was afraid when I heard insurance companies are dropping out of long-term care insurance that they would begin no longer paying their claims. Right? That's common sense. We would have that fear. So we've watched that fear when companies dropped out and they are still paying their claims. So what this is saying, this report is even saying, a large portion of these claims that are being paid right now are from companies that are no longer providing long-term care insurance. So in essence, what it means, to translate that means, if you buy a long-term care insurance policy, if you had bought one in the past, it is most likely, but not guaranteed, that that policy that you bought back then, if the company is still there, then they're going to probably pay claims on old policies they sold you. And I know that's your greatest fear. So unless the company's belly up or bankrupt, you probably have a good likelihood that your policy is still good. And if they're still collecting premiums, you probably have a fairly high certainty that your claims will be met. So I need you to call your companies, if they're older companies that you know dropped out of the market, and I need you to ask them, is my policy still valid? And I think you'll hear a comforting answer of, yes, it is, and the coverages are still valid, and we're still paying claims on an ongoing basis. And this report confirms that as a rule, that they are indeed continuing to pay a large majority of these claims, even though they're no longer participating in selling any further new long-term care insurance. So I hope that's reassuring to many of you when we're shopping now for what's going to happen in the future. So which brings me to, all right, find big, strong, financially sound insurance companies who have a large presence in the long-term care insurance industry, giving yourselves the best odds and percentages that those companies will still be standing 20 and 25 years from now when you might need your policies to pay out benefits on the policies you're considering purchasing now. So that's just a thought I'd share with you because it is somewhat comforting to know that and to read that. You know, we look at the partnership programs, and in this survey, it discussed the impact of the state partnerships for the long-term care. And it seems to be that the partnership programs are not quite being maybe fulfilled as much as they could be, because the partnership programs can really help. We'll talk about some of that. But remember last week and 2 weeks ago, I talked about tax deductibility of premiums. Remember I talked about an offsetting asset protection quality of being in a partnership program. A lot of people need to look at that a little more to make sure they're benefiting by all the provisions in the state partnership programs. Now, I want to give you a market perspective when I wrap today's show up. And when I come back next week, I'm going to continue with this survey. But get this. This report says, in a major change of direction, and I'm reading this again, women's prices are now generally at least 50% more than men's prices. Well, you know why. I just told you about the different type of pricing methods that they're doing now. And the premium differential, they're saying, is justified by long-known claims differences. And we do know that. Everybody that you talk to will say women live longer than men. It might not be true in one person's particular case, but in the overall statistical law of averages, it has proven to be true. It says prior to 2013, insurers priced, and this is what I talked about, individual long-term care insurance, assuming that most buyers were females. So that's kind of interesting because they were pricing it a little bit on the high side. Couples discounts reflected that nearly every couple included a male. So you get to hear that prior to 2013, single males might have been potentially overcharged then. A married couple might not have been because it balanced, but single males might have been overcharged. When we shift to gender distinct pricing, now most insurers use more conservative investment yield assumptions, which is holding the prices up now on the men. So what we've got is we have the gender distinct pricing, which should reduce men's, but it didn't, because our interest rates are so low. And another factor on pricing is how much can the insurance company make on the dollars that they're bringing in, and lo and behold, they can make next to nothing in their economic view on that. So because of such low investment yield assumptions, men's prices have stayed the same and women's prices have gone up about 50%. Huge dynamic change. Okay? And about 6 out of the 13 insurers have gender-based pricing. So you can go either way now, but I think that will probably go away. All right. I'm going to end the show because we're out of time. I will come back and help you with decisions in how to buy long-term care insurance, what provisions to watch for, and give you guidance as I did today, gender-based versus not gender-based and things like that, so you know what to look for and know what to ask. Okay, folks, we'll be back again next week. Thanks for tuning in to another edition of All Things Financial.
You've been listening to All Things Financial with your friend with the answers to all financial matters, Jack Driscoll of Driscoll Insurance and Financial Services. Securities and investment advisory services offered through Sage Point Financial Incorporated, a registered broker-dealer and registered investment advisor and member FINRA and SIPC. Driscoll Insurance and Financial Services is not affiliated with Sage Point Financial, Inc. or registered as a broker, dealer, or investment advisor. You can reach Driscoll Insurance and Financial Services Incorporated at 412-833-1500, and they are located at 2738 South Park Road, Bethel Park, Pennsylvania, 15102.